the professional investment market is finally catching up to Bitcoin. And the cool thing for us as retail investors, we've been able to front run these guys. I saw a great stat recently that something like, maybe I'll dig it up. I have to find it. But like 50% of hedge fund managers own Bitcoin personally, but only 3% of funds actually carry it, I think was the stat. James's newsletter is excellent. I highly recommend you subscribe because it helps me to see a world that I'm not professionally trained investor. And I never will be, for that matter. I'm not going to go manage someone else's money, at least not in the near term. And I want to know what to do with my money. Like, what are the best decisions I can make? And when I get information like this, it helps with improving my toolkit, essentially. Now, James goes into more details about something called the VIX, which is to do with volatility. He touches on MicroStrategy and how MicroStrategy is managing to sell Bitcoin volatility as Bitcoin yield. But what's fun to think through here is it's like, okay, well, if Bitcoin is a $2 trillion asset, there's $900 trillion out there. Who's in control of that money? Well, the truth is it's a small percentage of people of the total population. And you've got a difference, keep in mind, between the owner of the asset and the manager of the asset. And so, yes, there are crazy stats out there that show you, like, a small percentage of the total population own everything. But keep in mind that money, they might own it, but they're not necessarily in control of it because it's in businesses as equity, or it's in funds as capital allocated. So you can't necessarily turn around to your fund manager and tell them what to do with it tomorrow, because you've actually made the bet that fund manager is going to look after you in whatever format that might be. It could be a venture capital fund. It could be a private equity fund. It could be just a standard kind of wealth management financial advisor type setup where they've gone for a 60-40 bond allocation, stock bond allocation. I don't know, but the point is that the $900 trillion out there that's not Bitcoin is going to be managed by a handful of people. And so if you're looking at when the Bitcoin price might run even higher than it has so far, it's like, where's that actual capital going to come from? It's got to come from somewhere. Well, I know that Bitcoin performs better than real estate as store of value. And I know that it performs better than bond as store of value. So I see those two big buckets as huge capital outflows into Bitcoin. So inflows to Bitcoin, outflows from bonds, outflows from real estate. But the people that manage those assets are a small handful, right? And so they're going to sit there and they're going to say, okay, we've got this portfolio of assets today. We think it's worth this. We think we've actually grown in value over the last year by this. So, okay, how much risk did we have to take? What were the risk-adjusted returns like? And what was the Sharpe ratio? And I actually, shout out to Andy Edstrom, reading his book, Why Buy Bitcoin, all those years ago now, which I can't even remember when he wrote it, but I would have read it in probably 2020, 2021. It's the first piece of Bitcoin content I came across that had been written by a professional money manager. And so he was talking a language that I was used to hearing from people I'd hired on my wealth management journey. And I was someone who's obviously inherited money, and I knew that I had to do something with it, but I didn't have the skills to do it myself. So I had to outsource it. I had to give it to someone else to manage it on my behalf. And so, okay, when you do that, that person is then going to try and use sophisticated tools to make sure that they return their money to their client, and also they get paid themselves. So shout out to Andy for first being the person that really drew my attention to the Sharpe ratio. But here we are 5 years later, and it's more relevant than ever before, because all these people that control the $900 trillion worth of assets out there are using these kind of metrics to decide whether Bitcoin's a good idea or not. And it is a good idea through this traditional lens. And again, you go back to the Nakamoto portfolio, go and have a look at how it levels up against these other asset classes. It's absolutely mad how well Bitcoin actually does. So at the end of the day, like, this is super, super bullish. And this kind of language is the kind of language that these sophisticated professional investors use in order to make decisions. And again, for us as retail investors, like, it's awesome stuff, basically. It's like, okay, I can just go and buy Bitcoin, and I can know that I'm getting as good a risk-adjusted return as any professional out there is trying to get. And most of them can't even get close. Some of the different metrics that James is looking at, that Bitcoin's twice as good. It's absolutely it's absolutely, melting faces, as they talk about. So yeah, that's a really cool thing to read into. And as someone who likes to leverage other people's expertise to make decisions myself, this is just the kind of insight that I like reading about. When I'm like, okay, I knew about this, but it's helped me see it in a slightly different way. And it's why I like to pay for some newsletters, because you just get some great insights that, Monday morning, I'm like, yeah, let's bash through my emails. Oh, this is cool. Caught my attention. Boom, boom, boom. Suddenly you have a deeper insight on something. You feel better informed. And my conviction is as strong as it's ever been. The key takeaways for me: institutions are being forced to take notice of Bitcoin due to their portfolio construction metrics. Bitcoin is good for any portfolio. As retail investors, Bitcoin allocations mean we can get risk-adjusted returns that even sophisticated professional investors struggle to attain. Epic.